Can you handle the truth about Ethereum ETFs? Are you curious about Ethereum and how it can fit in your portfolio? You might have heard about these new Ethereum ETFs in Canada, but what's the real deal? Can they really help you diversify and potentially boost your returns? We're diving deep into the world of Canadian Ethereum ETFs today. We'll crack open the mystery box and answer all your burning questions. Are they safe? How do they compare to regular ETFs? What about the US market? Will they have better options? Don't worry, we'll sort through the jargon and make it all clear. By the end of this video, you'll be an Ethereum ETF pro, ready to make informed investment decisions. So buckle up, hit that subscribe button, and let's chat about Ethereum ETFs. Question 1. How closely does the ETF track the performance of Ethereum ETH? Does it hold actual ETH or derivative instruments? There are two main factors to consider when it comes to how closely an Ethereum ETF tracks the price of ETH and the type of holdings it uses. 1. Tracking mechanism. Physical replication. The ETF directly holds actual Ethereum ETH in its portfolio. This aims to track the price of ETH very closely, minus any fees associated with running the ETF. However, this structure might not be available for all Ethereum ETFs due to regulatory restrictions. Synthetic replication. The ETF uses derivative instruments like futures contracts or swaps to track the price of ETH. This can be more efficient for the ETF issuer, but might introduce tracking errors due to the costs of these derivatives compared to the underlying asset. 2. Expense ratio. The expense ratio is the annual fee an investor pays to hold the ETF. This fee covers the costs of managing the ETF, including buying and selling the underlying assets, or derivatives, and other administrative expenses. A lower expense ratio generally translates to closer tracking of the underlying asset, ETH, since less money is diverted from the fund's returns. In summary, look for an ETF that uses physical replication to achieve the closest possible tracking to the price of ETH. Pay attention to the expense ratio, as a lower fee translates to less deviation from the ETH price. Question 2. What replication methodology does the ETF employ? Are there any potential risks associated with the chosen methodology? There are three primary replication methodologies employed by Ethereum ETFs: physical, synthetic, and optimized. Each method offers distinct advantages and potential risks for investors. 1. Physical replication. Description: the ETF directly holds actual Ethereum ETH in its custodial wallets. This aims to precisely mirror the price movements of ETH, minus the ETF's expense ratio. Advantages. Closest tracking offers the most direct and transparent exposure to ETH price movements. Potential tax benefits. Depending on the jurisdiction, holding ETH directly within the ETF structure might offer tax advantages compared to individual ownership. Disadvantages. Regulatory hurdles. Securities regulators in some countries might be hesitant to approve ETFs directly holding cryptocurrencies due to concerns about custody and market manipulation. Lower liquidity. Physically holding ETH can pose logistical challenges, potentially impacting the ETF's ability to quickly buy and sell large quantities to meet investor demand. This could lead to tracking errors, especially in volatile markets. 2. Synthetic replication. Description: the ETF uses derivative instruments like futures contracts or swaps to track the performance of ETH. The ETF issuer enters into agreements with counterparties to achieve returns that mirror ETH's price movements. Advantages. Regulatory flexibility. Synthetic replication might be more palatable for regulators as it doesn't involve the ETF directly holding crypto assets. Potential efficiency. Derivatives can be more efficient for managing the ETF, allowing for easier creation and redemption of ETF shares. Disadvantages. Tracking errors. The cost of derivatives can introduce deviations between the ETF's price and the underlying ETH price. These are known as tracking errors. Counterparty risk. The ETF relies on the financial health of its counterparties in derivative contracts. If a counterparty defaults, the ETF could suffer losses. 3. Optimized replication, hybrid approach. Description. This method combines elements of both physical and synthetic replication. The ETF might hold a portion of its assets in physical ETH and utilize derivatives for the remaining portion. The allocation between physical and synthetic holdings is constantly optimized to balance tracking error and other factors. Advantages. Seeks to mitigate risks, aims to achieve a balance between the benefits of physical and synthetic replication, potentially reducing tracking errors and counterparty risk. Flexibility, allows the ETF issuer to adapt its strategy based on market conditions. Disadvantages. Complexity. This approach can be more complex for investors to understand compared to pure physical or synthetic replication. Potential for higher fees. Managing both physical and synthetic holdings might lead to slightly higher expense ratios for the ETF. Choosing the right replication methodology. The ideal replication methodology depends on individual investor preferences and risk tolerance. Here's a breakdown to help you decide. Prioritize close tracking. If the closest possible tracking to the ETH price is your primary concern, look for a physically replicated ETF, if available. Minimize tracking error. If minimizing tracking errors is crucial, consider a synthetically replicated ETF with a reputable issuer and a well-established track record. Balance tracking and risk. For a balance between tracking and risk, an optimized replication ETF could be a suitable option. Question 3. How often is the ETF rebalanced to maintain its target exposure to Ethereum? Are there any costs associated with rebalancing? The frequency of rebalancing in an Ethereum ETF plays a crucial role in how closely it tracks the price of ETH. Here's a breakdown of rebalancing and its associated costs. Rebalancing explained. An Ethereum ETF aims to maintain a specific target exposure to ETH. However, natural market movements can cause the portfolio to deviate from this target over time. Rebalancing is the process of buying and selling underlying assets, or derivatives, to bring the ETF's composition back in line with its target allocation. Frequency of rebalancing. The frequency of rebalancing varies depending on the specific ETF and its underlying strategy. Here are some common scenarios. Intraday rebalancing. This is the most frequent approach, with rebalancing occurring throughout the trading day to maintain the target exposure as closely as possible. This is more common with synthetically replicated ETFs that utilize derivatives with short lifespans. Daily rebalancing. The ETF rebalances its holdings daily to ensure close tracking with the ETH price. This is a common approach for both physically and synthetically replicated ETFs. Weekly or monthly rebalancing. Less frequent rebalancing might be used for ETFs with lower expense ratios or those that aim to minimize trading activity. However, this can lead to larger deviations from the target exposure in volatile markets. Costs associated with rebalancing. Rebalancing incurs costs associated with buying and selling the underlying assets, or derivatives. These costs can include transaction fees, fees charged by exchanges or brokers for executing trades. Bid-ask spread, the difference between the price at which an investor can buy, ask price, and sell, bid price, an asset. Impact costs, The potential price movement caused by the ETF's large buy or sell orders, impacting the average price at which the ETF executes trades. Impact of rebalancing costs. These costs can slightly eat into the ETF's returns and contribute to tracking errors. However, well-managed ETFs aim to minimize these costs through efficient trading strategies. Investor considerations. When choosing an Ethereum ETF, consider the following regarding rebalancing. Frequency. More frequent rebalancing generally leads to closer tracking of the ETH price, but might incur higher costs. Expense ratio. A lower expense ratio often indicates the ETF is more efficient with rebalancing, minimizing the impact on returns. Question 4. How liquid is the underlying Ethereum market? Can the ETF be easily bought and sold on the exchange? Liquidity is a crucial factor for both the underlying Ethereum market and the tradability of an Ethereum ETF. Here's a breakdown of both aspects. Liquidity of the underlying Ethereum market. Generally high, the Ethereum market is considered to be highly liquid compared to many other cryptocurrencies. This means there are typically a large number of buyers and sellers willing to transact at any given time. Potential for volatility. Despite its overall liquidity, the Ethereum market can still experience periods of high volatility. This can lead to wider bid-ask spreads, the difference between the buying and selling price, and potentially impact the ability to enter or exit positions quickly at the desired price. Liquidity of the Ethereum ETF depends on the underlying market. The liquidity of the ETF itself is ultimately tied to the liquidity of the underlying Ethereum market. If the Ethereum market is liquid, the ETF should also be relatively easy to buy and sell. Trading volume. The daily trading volume of the specific ETF also plays a role. ETFs with higher trading volumes are generally more liquid and easier to buy and sell at tight bid-ask spreads. Underlying holdings. For synthetically replicated ETFs, the liquidity of the counterparties involved in the derivative contracts can also impact the overall liquidity of the ETF. Here's how these factors can affect you as an investor. Reduced liquidity risk. Investing in an Ethereum ETF through a well-established exchange mitigates some of the liquidity risks associated with directly buying and selling ETH on a cryptocurrency exchange. Bid-ask spread. Even with a liquid ETF, there will still be a bid-ask spread. Pay attention to this spread to minimize the impact on your entry and exit prices. Trading volume. Consider the daily trading volume of the ETF before investing. Higher volume ETFs generally offer tighter spreads and easier execution of trades. Tips for investors. Choose an Ethereum ETF traded on a reputable exchange with high daily trading volume. Be aware of the bid-ask spread when placing orders. Consider the overall market conditions for Ethereum when evaluating liquidity. Question 5. Ethereum is a highly volatile asset class. How does the ETF mitigate or manage this volatility? Are there any options for investors to hedge their exposure? Volatility of Ethereum and mitigation strategies in ETFs. Ethereum's volatility. You're right, Ethereum is known for its high price fluctuations, which can be challenging for investors. While ETFs themselves don't directly mitigate volatility, they can offer some advantages compared to directly owning Ethereum. Limited impact on volatility by ETFs. Passive management. Most Ethereum ETFs are passively managed, meaning they aim to track the price of Ethereum without any intervention. Therefore, they inherit the inherent volatility of the underlying asset. Advantages of ETFs for volatile assets. Increased accessibility. ETFs provide a convenient and regulated way to gain exposure to Ethereum without the complexities of managing cryptocurrency wallets and exchanges. Potential tax benefits. As mentioned earlier, ETFs can offer tax-efficient rebalancing compared to directly buying and selling Ethereum. Diversification. For some ETFs, some Ethereum ETFs might hold a basket of assets related to the Ethereum ecosystem, not just ETH itself. This can offer some level of diversification, potentially reducing overall portfolio volatility compared to holding just Ethereum. Investor options for hedging volatility. Despite the limited mitigation within the ETF itself, investors have options to hedge their exposure. Diversification. The most common strategy is to diversify your portfolio by holding assets with a low correlation to Ethereum. This can help offset losses in Ethereum with gains in other asset classes. Options trading. For experienced investors, options contracts can be used to hedge against potential price declines in Ethereum. Options allow you to lock in a selling price at a specific point in the future, limiting potential losses. However, options trading comes with its own risks and complexities. Inverse or short ETFs. These are specialized ETFs that aim to profit from price declines in the underlying asset, in this case, Ethereum. They can be used to hedge existing Ethereum holdings, but they come with additional risks and fees. Question 6. The regulatory landscape surrounding cryptocurrency is constantly evolving. How could potential changes in regulation impact the ETF's operations? The regulatory landscape surrounding cryptocurrency is indeed fluid, and this poses a risk to Ethereum ETFs. Here's how potential changes in regulation could impact these ETFs. Areas of regulatory risk. Classification of Ethereum. Regulatory bodies might decide to classify Ethereum, or cryptocurrencies in general, as securities. This could lead to stricter regulations for ETFs holding them, potentially impacting their structure, fees, or even approval. Custody requirements. Regulators might impose stricter custody requirements for ETFs holding crypto assets. This could increase the costs and complexity of managing the ETF. Market manipulation concerns. Regulators might introduce measures to address concerns about market manipulation in the underlying cryptocurrency market, potentially impacting the tracking ability of ETFs. Exchange listing restrictions. Regulatory scrutiny could lead to restrictions on listing Ethereum ETFs on exchanges, limiting investor access. Potential impacts on ETFs. Operational disruptions. Regulatory changes might necessitate changes in the ETF structure or operations, potentially leading to temporary disruptions or suspensions. Increased costs. Stricter regulations could increase the costs associated with managing the ETF, leading to higher expense ratios for investors. Reduced liquidity. Regulatory hurdles might deter new ETF entrants, impacting the overall liquidity of the Ethereum ETF market. Performance deviations. Regulatory changes could affect the ETF's ability to accurately track the price of Ethereum, impacting investor returns. Mitigating regulatory risk. Issuers with regulatory expertise. Choose ETFs from issuers with a strong track record in navigating complex regulatory environments. Physically replicated ETFs. If available, physically replicated ETFs might be less susceptible to regulatory changes impacting derivatives used in synthetic replication. However, this is not a guaranteed safeguard. Question 7. If the ETF utilizes derivative instruments, what is the counterparty risk involved? Are there any measures in place to mitigate this risk? Counterparty risk is a significant concern for investors in synthetically replicated Ethereum ETFs. Here's a breakdown of the risk and potential mitigation measures. What is counterparty risk? Counterparty risk refers to the possibility that one of the parties involved in a financial contract fails to meet its obligations. In the context of synthetically replicated Ethereum ETFs, the ETF enters into derivative contracts, like futures or swaps, with counterparties to track the price of Ethereum. If the counterparty defaults on its obligations, the ETF could suffer losses. Examples of counterparty risk. Futures contract default. If the counterparty selling the ETF futures contracts defaults, the ETF might not receive the underlying Ethereum upon contract expiry, leading to potential losses. Swap counterparty failure. In a swap agreement, the counterparty might fail to deliver the agreed-upon Ethereum or cash flows, impacting the ETF's ability to track the underlying asset. Mitigating counterparty risk. ETF issuers take steps to mitigate counterparty risk, but it cannot be entirely eliminated. Here are some common mitigation strategies. Using creditworthy counterparties, ETFs aim to partner with reputable financial institutions with strong credit ratings to minimize the risk of default. Collateral requirements. The ETF might require counterparties to post collateral, which acts as a security deposit in case of default. This collateral can be used to offset potential losses. Diversification of counterparties. Distributing derivative contracts across multiple counterparties reduces the risk associated with relying on a single entity. Daily margining. For certain derivative contracts, daily margining practices are used. This requires counterparties to maintain a minimum deposit level, which can be adjusted daily to reflect market fluctuations and potential losses. Question 8. In the event of a sudden market downturn, could the underlying Ethereum market become illiquid, impacting the ETF's ability to meet redemption requests? Liquidity risk is a concern for both the underlying Ethereum market and the tradability of an Ethereum ETF. Here's a deeper look at how a sudden market downturn could impact an ETF's ability to meet redemption requests. Potential for illiquidity in Ethereum. Generally high liquidity. The Ethereum market is considered to be highly liquid compared to many other cryptocurrencies. However, even in a liquid market, sudden downturns can lead to increased bid-ask spread. The difference between the buying and selling price of Ethereum can widen, making it more expensive to buy or sell large amounts quickly. Reduced order book depth. Fewer buyers and sellers might be willing to participate at specific price points, limiting the ability to execute large trades at desired prices. Impact on ETF redemptions. Redemption mechanism. When investors redeem their ETF shares, the authorized participants, large institutions that create and redeem ETF shares, typically sell the underlying assets, or derivatives, to meet those redemption requests. Downturn challenges. In a sudden market downturn, the authorized participants might face difficulties selling large amounts of Ethereum quickly due to potential illiquidity in the underlying market. This could lead to delayed redemptions. Investors might experience delays in receiving their redemption proceeds if the ETF struggles to sell the underlying Ethereum. Tracking error. The ETF's price might deviate from the actual price of Ethereum if the authorized participants are forced to sell at lower prices due to limited liquidity. Mitigating liquidity risk. Physically replicated ETFs. If available, these ETFs hold actual Ethereum, potentially offering some buffer against liquidity issues in derivatives markets during downturns. ETF liquidity profile. Choose ETFs with a high trading volume, as these generally have better liquidity and are less susceptible to redemption challenges. Gate closure. Rare scenario. In extreme circumstances, the ETF issuer might temporarily halt redemptions to protect existing investors. However, this is a rare measure and can have significant negative consequences for investor confidence. Question 9. The cryptocurrency market is vulnerable to cyber attacks. What cybersecurity measures does the ETF issuer have in place to protect investor assets? The cryptocurrency market, including Ethereum, is indeed vulnerable to cyber attacks. Here's a breakdown of cybersecurity risks and how ETF issuers can mitigate them to protect investor assets. Types of cybersecurity threats. Hacking of cryptocurrency exchanges. If the exchange where the ETF holds its underlying Ethereum, for physically backed ETFs, is hacked, investor assets could be stolen. Cyber attacks on custodians. For both physically and synthetically replicated ETFs, hacks targeting the custodian storing the ETF's assets, or derivatives contracts, pose a risk. Malware infiltrating ETF infrastructure. Malicious software could infiltrate the ETF issuer systems, potentially leading to manipulation of NAV or disruption of operations. Mitigating cybersecurity risks. While eliminating cyber risk entirely is impossible, ETF issuers can implement various measures to safeguard investor assets. Security protocols and encryption. Strong encryption standards and secure coding practices should be implemented to protect sensitive data. Regular security audits, independent penetration testing, and vulnerability assessments can help identify and address potential security weaknesses. Cold storage of cryptocurrency. For physically backed ETFs, a significant portion of the Ethereum holdings might be stored offline in secure cold wallets to minimize online vulnerability. Multi-factor authentication. Implementing multi-factor authentication for all user access points adds an extra layer of security. Insurance coverage. Some ETF issuers might carry cyber insurance to help offset potential losses from successful cyber attacks. Investor considerations. Limited transparency. ETF issuers typically don't disclose all their cybersecurity measures to avoid giving away sensitive information to potential attackers. This can make it difficult for investors to fully assess the ETF's security posture. Indirect risk from underlying market. The security of the broader cryptocurrency market, including exchanges and custodians, can indirectly impact the ETF. Focus on reputable issuers. Choose ETFs from established issuers with a strong track record of security and a commitment to cybersecurity best practices. Question 10. Are there any alternative investment vehicles that provide similar exposure to Ethereum, such as directly purchasing ETH or investing in cryptocurrency funds? While Canadian Ethereum ETFs offer a convenient and regulated way to gain exposure to Ethereum, there are alternative investment vehicles to consider. Here's a breakdown of some options. 1. Directly purchasing Ethereum ETH. Pros. Potentially lower fees compared to ETF expense ratios. Full control over your Ethereum holdings, you hold the private keys. Potential for higher returns if the price of Ethereum appreciates significantly. Cons. Require setting up a cryptocurrency wallet and managing its security. Exposure to exchange and wallet hacks. Potentially higher transaction fees, depending on the exchange. Tax implications of buying and selling Ethereum directly. 2. Cryptocurrency exchanges. Pros. Easy to buy and sell Ethereum compared to directly managing a wallet. Offer various cryptocurrencies for purchase. Some exchanges offer staking or lending services to earn interest on your crypto holdings. Cons. Exposure to exchange hacks and security breaches. Some exchanges have limitations on daily withdrawal amounts. Not all exchanges are regulated, so choose reputable ones. 3. Cryptocurrency funds. Actively managed funds. Pros. Potentially higher returns through active management by professional investors. Diversification within the crypto space may hold other cryptocurrencies besides Ethereum. Cons. Higher fees compared to passively managed ETFs or directly buying Ethereum. Performance depends on the fund manager's skills. Less transparency compared to ETFs may not disclose all holdings. Venture capital funds. Pros. Potential for high returns by investing in early-stage blockchain startups. Professional management with expertise in the crypto space. Cons. High minimum investment requirements, often only for accredited investors. Long lockup periods for your invested capital, maybe several years. Very high risk due to the nature of early-stage ventures. Alright everyone, that's all the time we have for today's deep dive into Canadian Ethereum ETFs. Remember, the key takeaways are: 1. Canadian Ethereum ETFs offer a regulated and convenient way to gain exposure to Ethereum's price movements. 2. Consider factors like expense ratios, liquidity, and whether the ETF is physically backed or synthetically replicated when choosing an ETF. 3. They can potentially improve your portfolio diversification, but be mindful of Ethereum's volatility and how much weight you allocate to the ETF. 4. The US market is launching similar ETFs soon, so compare their features to Canadian options before investing. Before you jump in, do your own research, understand the risks involved, and never invest more than you can afford to lose. The cryptocurrency market is a wild ride, and Ethereum ETFs are no exception. But hey, with the knowledge you have now, you're well on your way to making informed decisions about Ethereum ETFs. If you have any questions, leave them down in the comments below, and we'll chat about it. Don't forget to like this video and subscribe to the Chat ETF channel for more investment breakdowns you can use.